All right, let's talk about three accounting terms that can seem a little intimidating: depreciation, provisions, and reserves. But forget the dry textbook definitions for a minute. We're going to do something different. We're going to follow the life story of a single business asset right from the day it's purchased. Trust me, it's the best way to see how these concepts actually work in the real world. So here's how we're going to break it down. We'll start at the very beginning, the day our asset is bought. Then we'll see how its value is tracked over the years. From there, we'll dig into how smart businesses plan for the unexpected and save up for the future. And finally, we'll get to the most crucial part, the key difference between the charge and an appropriation of profit. You know, every story has a beginning. And for our asset, let's say it's a new machine, its life starts the moment a business decides to make a big investment in its own future. And we're not talking about a small purchase here. This is a major capital expenditure.
Okay, let's put a number on it. Imagine a business buys a brand new production machine. The price tag is 180,000 rupees, and it costs another 20,000 for installation. So that brings the total initial cost to a nice, round 2 lakh rupees. And that number? That's the starting point for this asset's entire journey.
Now, obviously, the business knows this machine isn't going to last forever. They sit down and estimate that it'll have a useful life of about 10 years. Now, during that decade, it's going to be humming along, making products and bringing in revenue. This 10-year timeline is the bedrock for everything we're about to calculate. So, the machine is installed and running. Fantastic. But an asset doesn't stay brand new, does it? With every year that goes by, it gets a little older, a little more worn down, and this gradual, predictable loss in value brings us to our very first key concept: depreciation.
Yeah, that official definition sounds like a mouthful, doesn't it? But the idea behind it is actually super simple. Think about buying a new car. The second you drive it off the lot, its value drops. It's the exact same idea for a business asset. Depreciation is just how accountants measure that decline in value, whether it's from wear and tear, just the passage of time, or even because newer, better technology came along.
So, why do we even bother with all this? Well, it all comes down to a really important idea in accounting called the matching principle. See, it wouldn't make sense to record the full 2 lakh rupee cost as an expense in year one, right? Because that machine is going to be helping the business make money for all 10 years of its life. So, what we do is we match a little piece of the asset's cost to each year that it's generating revenue. It's only fair.
Okay, so how do we actually calculate this annual cost? Well, businesses usually pick one of two popular methods. The first is the straight line method. It's simple, it's consistent, you just take the total cost and divide it evenly over the asset's life. The other main one is the written down value method. With this one, you apply a percentage to the asset's remaining value each year, which means the depreciation amount actually gets smaller over time.
And you can see the difference right here. With the straight line method, our 2 lakh rupee machine gets a steady 20,000 rupee depreciation charge every single year for 10 years. Easy. But if we use the written down value method, let's say at 10%, the first year's charge is 20,000, but then it drops to 18,000 in year 2, and it just keeps on shrinking from there. Okay, so depreciation has us covered for the predictable loss of value. But what about the unpredictable stuff? What about problems you know are probably coming, but you can't be sure? Well, a smart business has to plan for those too. And that brings us to provisions.
A provision is basically the business saying, hey, I'm pretty sure I'm going to have this expense in the future, even if I don't know the exact amount yet. This whole idea is guided by what's called the prudence principle in accounting. It basically says you should account for losses as soon as you think they're likely, not just when you finally get the bill. You plan ahead. And this isn't some abstract theory. You see it all the time in the real world. For example, a business knows from experience that, sadly, a few of its customers just won't pay their bills, so it creates a provision for doubtful debts. Or it might set aside money for future taxes or some big repairs it knows are on the horizon. In every case, it's a cost against today's profit for a liability you know is coming. So far, we've only really talked about costs and expected losses. But what happens after the business accounts for all of that and it still makes a profit? What then? Well, this is where our final piece of the puzzle, reserves, comes into the picture. Now, I want you to pay very close attention to that word appropriation. This is a game changer. Unlike everything else we've talked about, a reserve is not an expense. It is not a charge against profit. It's a strategic choice to take a slice of the profit you've already earned and keep it in the business to make it stronger, instead of just paying it all out to the owners. And the order here is absolutely critical. You can't skip a step. First, the business earns its revenue. Then it subtracts all of its expenses. That includes depreciation and any provisions to get to its net profit. And it's only from that final profit number that it can then decide to create a reserve, setting money aside for future expansion, a special project, or just as a rainy day fund. This brings us to what is probably the single most important takeaway from our entire discussion, especially if you've got exams coming up. It's this fundamental difference between a provision and a reserve. And it all boils down to that idea of a charge versus an appropriation. So is this just a bunch of accounting jargon? No way. This distinction actually reflects two completely different financial actions. One is a necessary cost of just being in business, and the other is a strategic choice you make about the future. Let's really break it down. This table just lays it all out perfectly. Look at the difference. A provision is a charge against your profit. It's something you have to deduct before you can figure out your final profit. And because it's an expense, it reduces your taxable income. A reserve, on the other hand, is an appropriation of profit. You do it after your profit is calculated, and it has no effect on your tax bill. Basically, provisions are a must-do for accurate accounting. Reserves are a strategic choice. Here's a really simple way to remember it if you get stuck. Provisions are about playing financial defense. They're about accurately recognizing the costs and risks of doing business right now. Reserves, they're all about playing offense, building up your financial strength so you can grab opportunities and grow in the future. So you see, just by following the life of one simple asset, we find out that these aren't just boring accounting rules. They are the tools a business uses to tell its financial story, how it deals with the costs of today, how it prepares for the problems of tomorrow, and how it invests in its own success. The real question isn't just about how to do the math, but understanding the strategy behind it all.